This is Topic 7, Trusts, Lesson 7b, the tax burden. We established in video 7a that all income earned from trust assets needs to be taxed in the year that it accrues. The purpose of this video is for you to gain a better understanding of where that tax burden falls. Now, there are three parties that can be taxed on the income accruing from trust assets. The first is the original donor. That's in terms of Section 7, which we covered in video 6c when we did the donations tax section. So the first person that can be taxed is the original donor. The second person that can be taxed is a beneficiary with a vested right. So that's in terms of Section 25b, and we'll unpack that more in this lesson. And lastly, the trust. So the trust will get taxed if there are no beneficiaries with vested rights or no donor. So our starting point here is the rights of those beneficiaries, and we can find those rights in the trust deed. So beneficiaries can have one of two rights. They can either have vested rights or contingent rights. So someone with a vested right is entitled to that trust income regardless of when they receive it. So even though income might not be paid out to you in the current year of assessment, if you have a vested right to that income, it's going to be yours at some point. Therefore, you will be taxed on it. Then a contingent or discretionary right is a right that you have for income, which only becomes vested if the trustees make a discretionary distribution to you. So a vested right means that you are always going to be entitled to the income from an asset. A contingent or discretionary right means that you will only be entitled to that income if the trustees say that you are entitled to that income. Now, in terms of the tax hierarchy, we start with the donor in terms of Section 7. Now, Section 7 was discussed in more detail in the donations tax video 6c, and I suggest you re-watch that video if you feel like you need to recap any of those principles ahead of attempting the practice questions in this lesson. So for Section 7 to apply, there must be a donation, settlement, or other distribution or disposition, and that donor must still be alive. So if that donor has passed away, there can be no Section 7 attributions in that trust. What are the implications of Section 7? Well, any income from that donated asset is taxed in the hands of the donor rather than the recipient of that income, which in a trust case would either be the beneficiary or it would be the trust. So that income is diverted back and taxed in the donor's hands if any of those Section 7 rules apply. And in terms of those Section 7 rules, there are a number of specific transactions which I would encourage you to look at in your Income Tax Act and flag as you study. So the first of those is Section 7.2, and that's when a spouse benefits from the donation from the other spouse. So if I donate a rent-producing asset to a trust, and my wife benefits from the income, that income will be diverted back to me in terms of Section 7.2. What's important to note is that Section 7.2 can only apply if the sole or main purpose of that transaction was to avoid tax. So that's something you've got to look out for in your questions, but you will be given that information in an assessment. Section 3 and 4 deal with cases where children benefit from the donation of their parents. That can be a direct or indirect donation. But what's important there is that for Section 7, 3 or 4 to apply, a parent must have donated that asset. Not a grandparent, not an uncle, it must have been a direct parent. And children can be direct children, they can also be stepchildren. Then any income retained in the trust that's not vested could revert back to the donor in terms of Section 7.5. 7.6 deals with situations where the donor can revoke the vesting, so that income can vest in a beneficiary, and if at any point the donor has the right to take that income back, that donor will be taxed in terms of Section 7.6. Section 7.7 deals with the donations of the right to income without actually transferring those assets. So that's when I, as a donor, donate the actual right to income, but I keep the asset for myself. In terms of Section 7, if that donor still retains the right to that asset, the donor will be taxed on any income accruing from that asset. And the last of these Section 7 specific transactions is Section 7.8, and that applies when a non-resident benefits from the donation by a resident. So if a resident donates an asset and the non-resident is a recipient of the income, regardless of whether they're a major or a minor, that donor will be taxed on that income. So it's important to note there that if any income accrues to a major beneficiary, that major beneficiary will always be taxed unless they're a non-resident. That's the only time a major will be taxed on that trust income. The next thing to be discussed are deductions and allowances in terms of Section 25 Cap B. Now, if there are any legitimate deductions that have been incurred in the production of trust income, those are allowed to be deducted against that income. And the basic rule here is that the deductions follow the amount to which they relate. So if a beneficiary has included the trust income in their taxable income, they will be entitled to the deduction. Now that rule is subject to a few provisos, which we'll lay out now. The first of those in Section 4 prohibits the deductions from exceeding the total income accruing to that beneficiary. So basically the rule is there that you can't have a net loss as a result of the accrual of trust income. So the question is, if the deductions are in excess of the income, what happens to the excess? And 25B, 5 and 6 tells us what happens with the excess. So first rule is that if a beneficiary can't use all the deductions, the trust may utilize them. If there are still amounts left over and the trust can't utilize them in full, they are carried forward to the next year and the beneficiary can then utilize them for that following year against the future trust income. Income can accrue to the trust from both capital and revenue sources. And so in this part of the lesson, we're going to discuss the capital gains tax considerations of trust disposals. Now, there are two types of transactions which give rise to CGT consequences. The first is a disposal to a third party. So that's when the trust sells an asset that the trust owns to someone outside of that trust. We do a normal CGT calculation in that case. So sales price equals proceeds. Base cost is the open market value of the asset when it was acquired. We do a normal capital gains tax calculation there to come up with that gain in the trust. So the first transaction is where you sell an asset to a third party. The second is where we vest an interest in the trust assets to a beneficiary. So that's when we, instead of selling the asset and realizing the gain, we actually vest that entire asset into that beneficiary. So that asset becomes the beneficiary's asset rather than the trust asset. Again, we do a capital gains tax calculation on that date. The disposal date is the date that interest is vested in that beneficiary, and the proceeds are the open market value on that date. Remember, a beneficiary, a founder, and trustee are all connected persons in relation to the trust, so we always have to transact at fair market value. So when the trust disposes of an asset, the trust is liable for the CGT unless there's a special rule which applies to divert it. Now, in terms of special rules, these are housed in Section 80 of the 8th Schedule, as well as paragraph 68 to 72, which we'll have a look at now. So in terms of para 80, we include the gain in the beneficiary's income when either the beneficiary has acquired that asset or an interest in that asset, or when that beneficiary receives the capital gain, but not the actual asset. So that'll be a case when the trust has sold that asset, they make a capital gain, and they vest that capital gain in that beneficiary. Then, just like we have anti-avoidance, Section 7 in our Income Tax Act, the 8th Schedule has a similar anti-avoidance section, and that links up quite nicely with Section 7. So if you have a look at the table there, if there's a spouse benefiting from another spouse's income, we know that income vests in the donor's hands in terms of Section 7.2. The equivalent section for a capital gain is Section 68 of the 8th Schedule. So you can have a look here that 69 deals with minor children, paragraph 70 deals with retained income, revocable vesting is in paragraph 71, and residents benefiting non-residents are in paragraph 72. So basically, when the trust sells an asset or when the trust gives the asset to the beneficiary, we calculate a capital gain. That capital gain is taxed either in the beneficiary's hands in terms of paragraph 80 or in the original donor's hands in terms of para 68 to 72, or it can be taxed in the trust's hands as a last resort. The last item to be discussed in this lesson are non-resident trusts. Now, it's important here that you remember your source rules, which we discussed in the gross income section. So South African residents are taxed in South Africa regardless of the source of that income. If you're a South African resident, you're taxed on a residence basis, your worldwide receipts and accruals. If you're a non-resident, you're only taxed on South African source income. Now, the residence of the trust does not affect the source of the income. Remember the conduit pipe principle. So income flowing into that trust flows into the hands of the beneficiaries, and it doesn't change the nature of that income. So foreign source income flowing into the trust will be foreign source income in the hands of the beneficiaries, and vice versa. So a resident who acquires a vested right to retain income of a foreign trust is required to include that amount in their gross income in terms of section 25B2A. And so 25B2A will apply to any income streams which have been retained in that trust, and paragraph 83 of the 8th schedule will apply to any capital streams retained in that trust. That ends the video for this lesson. I'd like you now to just have a look at your Income Tax Act. I've highlighted a few sections which I think are important for you to flag and understand before you attempt the working examples.